In the halls of global finance, symbols matter. AAA. AAA. The pristine badge of sovereign credit. For over a century, the United States wore that badge like armor, untouchable, eternal, supreme. And then, on May 16, 2025, Moody's peeled it off. The downgrade, from AAA to A1, wasn't just a ratings move. It was a psychological shift. The kind that makes old empires tremble. Not because the numbers changed, but because belief did. Let's rewind. In 2025, America's national debt crossed $36 trillion. That's not a typo. $36 trillion. Equivalent to 134% of its GDP by the time we reach 2035. Interest payments on that mountain have exploded. Back in 2021, they consumed about 9% of federal revenue. Now, they're on track to devour 30% within a decade. 1 out of every 3 tax dollars will go to interest alone. And what's the plan to fix it? There is none. Political gridlock. Endless deficits. A refusal to raise taxes or cut spending. The fiscal future is a fog, and Moody's lit a flare inside it. Markets flinched. Yields on 30-year treasuries jumped past 5%. The Dow Jones dropped over 250 points at the open. The VIX, Wall Street's fear index, surged. It wasn't panic. Not yet. But it was a glimpse. Because this downgrade wasn't about math. It was about governance. Moody's wasn't just rating debt. It was rating discipline. And in their eyes, Washington is out of control. Now here's where it gets existential. If U.S. Treasuries are no longer sacrosanct, if even the last big 3 rating agency admits doubt, what happens to the system built atop them? Remember, treasuries aren't just bonds. They are the bedrock. The benchmark. The liquidity standard. From repo markets to pension funds, they are the dollar in disguise. And now? They shimmer with risk. Let's go deeper. In 2025 alone, the U.S. must refinance $7.6 trillion in maturing marketable debt. That's nearly a third of all its outstanding treasuries. It's not theoretical. It's now. And it must happen at a time when yields are rising, demand is thinning, and the dollar's halo is dimming. Foreign buyers, China, Japan, Europe, are blinking. Auction coverage is slipping. The era when Uncle Sam could borrow at will is closing. And that's just the surface. Below it lies a deeper danger, the carry trade collapse. As we explored in our last episode, Japanese institutions are pulling money home. Repatriating capital. Selling U.S. debt. Not out of malice, but out of math. Rising yen yields are shifting incentives. And now, the U.S. isn't just facing reluctant buyers. It's facing active sellers. Yields rise. Bond prices fall. Hedge funds using leverage to arbitrage treasury spreads are caught. Margin calls ripple through the system. A $200 million gain flips into a $700 million loss in 72 hours. It's mechanical. Merciless. This is how belief unravels. And in this unraveling, something new emerges. Because into the void left by sovereign trust, a strange alliance steps forward. Stablecoins. Yes, stablecoins. Tether, with over $150 billion in assets, $118 billion of it in short-term U.S. treasuries. Circle, issuing USDC, holds another $60 billion. These are not startups. They are shadow central banks. Buying what China sells. Absorbing what Europe avoids. The irony is profound. The assets designed to escape fiat now backstop it. The crypto rebels have become the lenders of last resort. And so the question becomes, is this resilience or fragility? If the US relies on Tether and Circle to fund its deficits, are we witnessing innovation or improvisation? Let's add another layer. This downgrade doesn't just affect bonds. It affects the dollar itself. The dollar's dominance, nearly 60% of global reserves, 88% of FX transactions, is rooted in trust. Not just in its value, but in its governance. In the rule of law. The independence of the Fed. The safety of treasuries. Now that trust has a crack. It starts small. A few sovereign wealth funds hedge into gold. Some central banks stockpile Bitcoin. Corporates explore issuing debt in euros or yuan. Transaction by transaction, the dollar loses ground. Not visibly, but persistently. And if this persists, we enter a new world. One where capital is cautious. Where buyers demand premiums. Where rates stay high, not by choice, but by necessity. And that's the quiet tragedy of the downgrade. It's not the loss of a letter. It's the loss of automatic belief. Now, what happens next? The Fed is watching. So is the Treasury. There are three paths forward. 1. Yield curve control. The Fed steps in to cap long-term yields by buying treasuries outright. But this risks inflation. 2. Stealth QE. Treasury taps its general account to inject liquidity, masking it as routine issuance. 3. Currency diplomacy. The White House quietly pressures allies, Japan, Korea, Gulf states, to keep buying bonds to preserve order. All are possible. None are painless. But the biggest risk? Doing nothing. If belief breaks further, capital could flee. Gold surges. Bitcoin breaks $150,000. The dollar dips, not into collapse, but into question. And questions are fatal to reserve currencies. So what should you watch? Watch bond auctions. Look for bid to cover ratios. Weak demand is the canary. Watch Tether's treasury holdings. If they pause purchases, that's a red flag. Watch foreign flows. If Japan and China sell together, it's DEFCON. Above all, watch the narrative. If the downgrade becomes a meme, it becomes self-fulfilling. Confidence is a currency. And America just saw its exchange rate slip. This isn't 2011. That downgrade was a warning. This is 2025. This is an awakening. Thanks for watching FluxFolio Finance. Subscribe, share, and let us know. Is this the start of a debt spiral, or a long overdue reset? Stay curious. Stay liquid. Stay awake.